Okay, since there is nothing to be asked, let's move on to today's lesson, which is adjustment to final account of a sole trader. So the point here is that, you see, now we have been able to know the format. And please, you need to remember the format. It's very, very important. You need to know the format for the trading account, the format for the profit and loss account, the format for the balance sheet. Okay. Now, after you have seen the format, you should also familiarize yourself. Last time we saw for the trading account, let me go back for the benefit of doubt. Let's go back for the benefit of doubt. So for the trading account, you see that these are the items that you need to be able to prepare the trading account, right? So you have the sales, return invoice, opening stock, purchases, carriage invoice, return outwards, closing stock, and then trading expenses. These are the items you use in the trading account. The same way, when you get to the profit and loss account, you need the income, okay, and expenses. So especially for the expenses, please try as much as possible to familiarize yourselves with the expenses that you need to know. And then we spoke of the balance sheet as well, which has the assets, liabilities, and capital in there. So if you are very comfortable, then you can now zoom into the adjustment. Okay. So for the adjustment, what do we mean? Let's quickly look at the definition of adjustment. So one of you should read for me, please. I think Bishop should do it for us.
Adjustments are corrections or further corrections that are effected in the final account of the year. So, adjustments are corrections or further corrections that are effected in the final account of business.
Okay, thank you very much, Bishops. Can you add the closing entries for me as well?
Closing entries are the general entries made at the end of an accounting period to transfer temporary account balances to permanent account.
Okay, thank you very much. So, let me quickly explain these concepts, and then you see there are not any kind of strange things we do. When we say adjustment, we referring to corrections, okay, you have to effect in the final account. So it can so happen, like for instance, what happened yesterday, where we interchanged the figure for carriage outwards and carriage inwards. If it comes to our notice with such a mistake, then we have to go into the account and make the adjustment. It can happen that maybe your sales figure is supposed to be 500,000, but you recorded it during the preparation of account, you recorded it as 600,000. If that happens, you have to make the corrections or further working. So that's what we mean by further workings or corrections. Okay. Now, apart from the adjustment, as in the corrections that you do, it is also important to know that in financial accounting, some of the accounts we prepare are just temporary. They are temporary because at the end of the financial period, we transfer their balances into the permanent account. Now, the permanent account in financial accounting include the trading account, profit and loss account. Okay, so you can reckon that the sales account, purchases account, all the expenses account, or the income account, they are temporary because we transfer these accounts into the trading account and profit and loss account. Okay, now when you talk of the account for the assets, liabilities, and capital, these are not temporary because we keep holding their balances and carry them on to the next year. But when you look at the expenses and the income and the revenues and those accounts are temporary because at the end of the year we transfer them to these two main accounts, which is the trading account and profit and loss account, to determine our profit and losses. So that is what we mean by closing entries. Okay, so we'll be doing a lot of these adjustment corrections, but let me quickly remind us that we are going to look at 10 basic adjustments to the final account. It sounds plenty, but it's very, very easy. So 10 basic adjustments to final account. In terms of examination and specifically for WASI, they don't assess or examine on all the 10. Most of the times you have just 3 or 4 of them which are highly examinable, and I'll alert you on that as we move on. But we need to go through all the 10 adjustments. The first one is what we call accrued expenses. Accrued expenses. So those who want to take notes, you can, or better still, I'll share the notes with you on the page. Accrued expenses. I will get to explain these things. So for now, let's just list them. We have prepaid expenses, income owings, income prepaid. We have goods withdrawn for owner's private use. And I want to believe we are all aware that anytime the concept of owner's private use comes into the picture, then recognition is given to drawings, right? So this is to inform you that some of the drawings may be in the form of goods. So somebody who is selling shoes uses some of the shoe for his own private use. Cash withdrawn for owner's private use. So the owner can also take cash of the business for. And then the next one is the proprietor's private expense charged against the firm's expense. This is also another form of drawings. Okay. The other one is provision for depreciation. And professors, this provision for depreciation is going to be manifesting itself in your journey as financial accountant. Majority of students believe that it is very difficult, but please, from today, don't ever conceive that depreciation is difficult, because immediately you have that conception, you set yourself to struggle with it. We also look at bad debt and another provision, but this time for bad and doubtful debt. We'll explain these terms. And then finally, interest on loan. So these are the 10 adjustments we have to go through quickly. Expenses owings or expenses accrued. Please let's note that in accounting, when you see the word accrued, which is from the word accrual, it refers to owings, which means that there is some outstanding or it is due for payment, or what you commonly used to know as arrears, or you can also say unpaid. So if you owe your landlord rent, then we could say that you have some rent accrued, or rent owings, or rent outstanding, or rent due, or rent in arrears, and then rent unpaid. On the other hand, when you see prepaid, it means that you have made the payment in advance. So we call payment in advance. So the scenario I just gave, if you are renting a room, you can pay for 3 years advance. Normally, that's how they call it. You pay for 3 years advance. What it simply means is that you have paid in excess of what you are currently due to pay. So let's pick them one by one and delve into each of them. In fact, ideally, it's supposed to be 11, but the first one, we are used to it. That is the closing stock. That is why we don't add that when we are doing the discuss on adjustment. But closing stock is the first adjustment you have to pay attention to. Okay, so dear professors, we pick on accrued expenses. Accrued expenses. Please, can we read this for us? The gentleman did it, so let me pick a lady. Prof. Alexia, have you eaten well enough to read for us?
Yes, please. It is accrued expenses. Refers to an amount of expense that have been incurred but not yet paid for. It is also called expenses, due or outstanding or unpaid or owings. Accounting treatment in the final account. Profit and loss account. Expenses due is added to the expenses paid and the result debited. Balance sheet shown as a current liability.
Thank you very much, Professor. So I think we would look at realistic scenarios to adjust this accrued expense when we reconnect in the next session. So please, this session is up. Let's reconnect with the second session details, and then we move on. Thank you very much, professors.